Hey guys, this is Andre from Wealthy Neighbor. Hope you are all doing well. In this video, I'll talk about the difference between investments and speculation. Please take a minute to read our disclaimer, and if you agree with all the terms and conditions, let's move on. First, I'll give some textbook definitions about investment and speculation. A fancy one I got from Wikipedia and a straightforward one that, in my opinion, is much easier to understand. Then I'll give you guys some examples to make everything clear, and finally some best practices to tell investment and speculation apart. First, investment. I will read this text to you guys just to make it easier, but if you want to read the whole article, I got it from Wikipedia. You just have to search for investment. So, according to Wikipedia, investment, in general, to invest is to allocate money or sometimes another resource such as time in the expectation of some benefits in the future. For example, investment in durable goods, in real estate by the service industry, in factories for manufacturing, in product development, and in research and development. The most important ideas here to invest is to allocate money in the expectation of some benefits in the future. Next, speculation. Again, the Wikipedia definition. Speculation is the purchase of an asset, a commodity, goods, or real estate with the hope that it will become more valuable at a future date. In finance, speculation is also the practice of engaging in risky financial transactions in an attempt to profit from short-term fluctuations in the market value of a tradable financial instrument, rather than attempting to profit from the underlying financial attributes embodied in the instrument, such as capital gains, dividends, or interest. The most important point, speculation, is the purchase of an asset hoping that it will become more valuable in the future. It can also mean risky financial transactions aiming to profit from short-term market value fluctuations. Now that we are familiar with the fancy definition, I will give you a more straightforward and simple one so you can tell your friends and family what investment and speculation is all about. So investment is the purchase of financial assets in order to build wealth over the long term, 5+ years, through capital gains, dividends, and interest. On the other hand, speculation, to buy or sell financial assets hoping to profit from market price fluctuations over the short term once your position is closed. Here I have or sell in parentheses because we can open short positions in the market, which means selling a stock we don't have, hoping that the price will go down so that we can repurchase this stock in the future, paying a lower price and profit from this transaction. When we speculate, guys, we are trying to take advantage of the market fluctuations. So we want to make some profit on a trade based on the price difference between how much we paid for an asset and how much we were able to sell it after a short period of time. But when we talk about investments, the first thing that comes to mind is the buy and hold strategy. So we will spend some time researching, and then once we are more or less sure, we'll try to buy some assets with a long-term mentality. We know that we will hold this asset for some time, at least 5 years. So we don't care about the punctual market price fluctuations. We don't care about the daily price quotes. We don't care about not so significant news that affect the asset price. All we care about is how likely this asset is to perform well in the future. So if we invest in a company by buying its stock, We expect that this company will be around for a very long time, will be profitable, will pay dividends to their stockholders, and will earn us some money on our investment, thus building wealth over the long term. So the most important idea here, guys, is when we invest, we are concerned about the long term. And when we speculate, we are concerned about the short term. To make things easier, let's see some examples. Consider this strategy: dollar cost averaging on a mutual fund using retirement account capital. What do you think this is? Is this investing or speculating? Let's see these characteristics. So we are in for the long run. The funds or the capital we use to buy this asset comes from the amount we save month to month. By prioritizing our expenses and spending money wisely, our goal is to grow wealth towards our retirement. So this can be considered a low risk investment as long as we make sure we are not overpaying for it. The second example, shorting Amazon stock without hedging. What do you guys think this is? Is this investment or is this speculating? Let's see the characteristics. So this trade should be closed quickly because we do not want to borrow Amazon stock for a very long time. By opening this position, we are potentially using broker leverage because we are shorting Amazon, so we don't actually own the stock. And anything can happen with its market price. The goal of this trade is to profit from a correction in stock prices. We decided to short Amazon because we think that it's currently overpriced, and we believe that a price correction is long due. So the moment the stock price starts to go down, we will rebuy the Amazon stock we have shorted earlier to close our position and profit from this trade. This is a high risk speculative strategy because first, we have no idea whatever Amazon prices will go up or down. We may think it's overpriced, but the market price can keep going up for some time, who knows? Second point, we have shorted Amazon. So we borrowed stock or money from our broker to open this position, and we will have to pay the broker back. And third point, no hedging. We did not hedge or protect ourselves from unexpected price moves. So in this case, we do have a lot to lose. These two strategies show the main differences between how an investment works and how speculating work. But guys, keep in mind here that I'm not saying that speculating is bad and you shouldn't do it. Although I do believe it that investing is good and everyone should do it at some point of their lives. Now that we know the differences between investing and speculating, I will show you guys some best practice to tell them apart and make sure we are doing the right thing. So first and foremost, keep your financial goals in mind. Are you building wealth or are you after short-time profit? If you want to build wealth, you should be investing. If you are after short-term profits, you should be speculating. As long as you know your objectives and you know more or less the plan you need to follow to reach these objectives, you will be able to pick the right choice for you. Make sure you know what you're doing. There is a time to invest and there is a time to speculate. So as I said before, I'm not condemning speculation here, guys. A lot of people make a lot of money from the stock market. Some people can also make money from gambling in casinos or even winning draws in lottery tickets. Guys, keep in mind that both investing and speculating have no guarantees, but speculating is much more riskier than investing because the odds of being successful or profitable consistently are quite low. Investing should be a habit and you should use the money you are able to save month to month, whereas speculating should only be done with money you can afford to lose. You should not risk capital you might need later Because in the worst case scenario, you can lose 100% or even more of the money you're using to speculate. And what if something bad happens, like you lose your job or you're involved in an accident? So you need some money to cover those expenses, and then your only option will be borrow money from bank at really high interest rates. So all the effort you put into saving money will be for nothing. Extraordinary IQ is good. Everyone wants to be intelligent. But for your finances, an average IQ, discipline and patience are more important. So when we talk about investing and building wealth, it doesn't matter if you are the smartest person in the room. Actually, being too smart may even hinder your investing capabilities because you keep second guessing yourself all the time. Of course, you need to read and research the assets you're going to buy. But the emotional factor that comes from discipline for following your objectives and your plan and your investment plan, and also patience to wait for the right time to buy your investments, are also very important for successful investments and building wealth over time. It doesn't matter if you're investing or speculating, but know what you're dealing with. Don't buy stuff you don't understand because things can backfire, guys. Make sure you read disclaimers, asset information. Make sure you know how option works if you plan to trade options. Make sure you know what indexes are if you are planning to trade futures or something. Don't forget to do your homework and don't be lazy. When we talk about investing, the most powerful tool we have is asset valuation, which is something people use to try to determine what is the intrinsic value of an asset. For example, you can try to evaluate a company based on its tangible and intangible assets, its cash flow, its ratios, its stock price, and so on. Be very blunt here, guys. Asset valuation is time consuming, very complex, but it's very useful to identify good investments. If we are willing to commit our money and invest in a company or buy real estate, asset valuation is the way to go because it will help reduce risk in our investments because we are buying something we expect will be profitable. Important tip, guys, do not buy overpriced investments. Do you know ROI? Return on investment? It's the ratio of net profit divided by the cost of investment. So the more you pay for an investment, the lower your ROE will be. Here, many people like to buy stock in a bull market because prices are going up and everyone else is buying. So this naive person will think, oh, this must be a good time to buy stock. I don't want to miss this move. And without thinking twice, the person will hit the buy button and enter a market order for some overpriced stock. Big mistake because prices don't trend in one direction indefinitely. Sooner or later, there will be a correction. People will start to sell and the market price of your stock will drop. So no matter how good an investment seems to be, make sure you're not overpaying for it. Wait for the right time and try to buy it when the market price is close to the intrinsic price or after some sharp price drop. What's the best way to make money, guys? Not losing money. Yeah, right. So take a look at this formula here. The profit needed to recover from a loss. Y is the profit equals x divided by 1 minus x divided by 100. And this formula basically tells us that we need a bigger profit in percentage terms to offset a loss. So I went ahead and plotted two charts. This first one starting from initial investment of $100. In the x-axis we have the lost amount in dollars, And in the y-axis there are the percentages. Blue points show the loss percentage. Since the initial value is 100, it's pretty straightforward. So when we lose $20, it's equivalent to a 20% loss. When we lose $40, it's equivalent to a 40% loss. So the loss percentage is a first order function of the loss amount. And the red squares show the gain needed to offset the previous loss at a given amount. So for example, for a loss of $20, we have lost 20% of our investment. And to go back to 100%, our previous 100%, which is equivalent to $100, we need more or less a 22% gain. And to offset a $30 loss on a $100 investment, we need more or less a 42% gain. And to offset a 50% loss, we need a 100% gain. So we need to make twice as much to break even if we lose 50% of our investment. Here in this chart, we can see that the gain to offset is not a first order function, but it looks exponential. And here, when I plot from 0 to a 95% loss, we can see that it really is exponential. And what I'm trying to say, guys, is that in percentage terms, it's more effort to break even after a loss. And this is made even worse when we are trading because of all the psychological factors that come after a loss. When we are invested for the long term, say 10 years, we don't really care if we have 1 or 2 bad years, because historically the stock market will yield positive gains over the long term. But if we are speculating and we have a disastrous loss, we forgot to set a stop loss or we didn't hedge properly, it will be hard to break even, both mathematically and psychologically. When you speculate, do not speculate when you think you are investing. Do not speculate seriously if you lack the knowledge and skill for it. And don't risk more money than you can afford to lose. Remember that many people have made a lot of money in the stock markets. And if we don't take risks, we never know what's going to happen. The only thing we know is that we are not going to make any money out of it. But please know what you're doing and be careful when you speculate. This is it for this video, guys. We learned the main differences between investing and speculating. And we can roughly say that what differentiates investing from speculating is time, or how long you are planning to hold your asset. Thank you for watching, guys. Let me know if you have any questions or suggestions, and see you next time. Bye bye.